Liquidity in the market. How do you find it? How do you trade it? How do you use a line chart to find liquidity? So let's look at the different types of liquidity we're going to be looking at today and how we can use that with the line chart. There are two different types of liquidity we look for. We're looking for liquidity at swing highs, and we're going to look at what we call engineered liquidity. So let's have a look at what we'd be looking for. If we had a down move here in the market, okay, so this is our current move down. We then find the market makes a reversal and the market goes back up like this. This is a typical reversal area. Okay, when we see the market making this last push down to take out any liquidity down here and we're pushing up, okay, we can expect the market to want to run liquidity above these highs. These highs on these moves down will all have liquidity. Now I created this high, so it's equal high. That means when we see the market come up to this high and it fails to take that liquidity, it's pushing back inside here. Okay, and what we look at is our trading range. Okay, so our trading range would have been from, say, this high to this low, and we see the market going through that trading range. Now, as a way to understand whether a trading range is going to actually show you a reversal back down, okay, so with a trend or it's a full reversal. Now here we can understand that these swing highs are going to leave you that area of liquidity where price will want to run. Now when we have this pullback here, which I created this swing high to be an equal high, inside this area you're going to find the market, okay, it's going to create those bullish swing moves like this. So what do you think this is going to create? When the market pulls back on this swing pullback, it's running liquidity, okay, through these lows. Pull back, we run the liquidity again through this low, pull back, and finally we're going to run liquidity at this low here to then pull back. Now very often you're going to find the market's going to want to break through this high to run this area of liquidity to engineer liquidity so it can then run back down once again to take this low before we see the true reversal back to the upside. So let me just zoom in on this area. So when we're looking at this swing pullback, remember we just went through, okay, we know that these highs, these lows, and that's the perfect example, I know, but we can see that the market's running these lows all the way down, taking liquidity at these lows. We get to this final low here. So we run the liquidity within the trading range itself. At this point, this is our trading range. Now this is going with a breaker structure here to the upside, so it's going with a bullish trend. On the pullback, we're running through that liquidity. Finally, we run the low here, and you think the market's broken this high, and it's a reversal. So our internal structure has reversed. The market then pulls back after it's broken that structure once again to run this low, which is our engineered area of liquidity, to run higher, and then we pull back for the continuation. So I'm going to just do that sketch for you once more. So imagine this is our, okay, move down, pull back, move down, pull back on that trend. That's our internal swing down, okay? And eventually we see the breakout here to the upside. And at this point, you're looking for an area of demand to hold price to continue higher. Now that's what the normal area would be looking for, a buyout here, okay, to continue higher. Now very normally, why we see this area, we see the break of this high. Now very often it's going to be just more of a false break, okay, but still a valid breakthrough to bring in those buyers to think it's going to higher. Now what we're going to see very often here, and let me just show you, is that very often when we have the market pushing up here and we're having this swing pullback to go higher with our swing structure, what we're actually seeing is that the market, and if I draw this in correctly for you, this is our, okay, move up, okay, and pull back, and then with continuation, leaving a new area of demand here, okay, for an entry. Now what you're very often going to see is that the market is failing, okay, to go into this area of demand. we just sit above that demand zone and we break out. And what you need to say to yourself here, okay, you're pulling back into an area of demand to go with the trend, and we failed to get to that demand zone. Yes, we can see this show you reversal on internal structure. So you've gone from a bullish swing structure to a bullish internal structure. That's how you'll read structure of the market, but there'll be another video going through structure in much more detail. But if you understand that this has failed to get to your demand zone and we see this reversal, potentially what this is going to create is a sweep of the market, manipulation, false breakout, whatever you want to call it, okay, to bring in buyers back into this area of demand here. But what you're actually going to see in reality is that this move here will not happen and will go down into that demand zone, taking the low once again, where we have the liquidity sitting engineered by that false break to the upside. And then you're going to see the true move back up with that swing structure. So hopefully you are understanding how this works. So this would be your true move to the upside. You have that final push down and then a continuation up. So we just move that over. You'll see exactly what I mean. So if the move came down, takes this low, and then we push away. So this area of demand, you'll think, okay, didn't work. And it's just an early entry. But then you can see the market will pull back into a new area of demand created, which is a valid zone to buy from. And this is going to stop you taking trades too soon, getting losses you shouldn't be getting into. Let's go through this now on a line chart and see how this will look like on the line chart, how you can use this going forward. Now, there's also a way to look for liquidity at where we're going to find market close prices. So if we look at this area here, what we have is our simple line chart. And when we're looking for liquidity, we're looking for those areas where price will want to just wick through, okay, take that liquidity and run. Now, the liquidity we're looking at is we have an area here of liquidity where the market's going to go back, take those lows, equal lows here, runs them and continues higher. But the actual liquidity that you want to be trading, okay, let me see if we can find one, is right here. Okay, the current price, we have an area here of liquidity. We have price here. Let me just show you what happened. We have this continuation here to downside. So the market has been pushing down, okay, all the way down here. We've been pushing lower and then we pull back. The market pushes down. Internally, we break out here, one final push up, and then we continue to drop. That is taking liquidity, okay, within this trading range. So we have a swing high based on closed prices, this is, and a low. Within this move up, okay, we look for a liquidity move. So again, if we was to do this off this swing high and this swing low, there's no liquidity here. We create the liquidity here when we break through this low. This is what we class as that engineered area of liquidity, where the market's a false break to downside. We pull back for one final false break here to the upside. You can see how we come back into this area and then we continue the true move to downside. So let's look at now understanding this swing pullback. We're inside this trading range. Let's now go down to the 15-minute chart. Let's have a look at what happened here. And you'll start to really understand the markets. And I'm just going through a simple pair, the US dollar CAD, okay? And we can see the market does the pullback within this trading range. What do we have? We have not only that sweep, we also sweep this area here at the same time. So the market does what here? We come up, we pull back, okay? We do break the low here to downside, okay? Equal lows here. So what we create here, in fact, is the area of liquidity. Mark that out for you. Area of liquidity that want to be taken. There is the last first push up. Okay, we pull down, remove this high. So we take out this high with this move up. We then break down once again and one final push up again to remove the first and the second area. And then we have the true breakdown to take out that low here of liquidity. Now, this is quite confusing if you're not really sure about understanding the way the markets move with liquidity, and using a line chart is going to make this much more simple. Let's go back to the 4-hour. Let me demonstrate this again. Okay, I haven't even looked at this chart, and this is what I'm now doing. I'm going through it for you. So we have again, okay, swing high. Let's in fact just use the dashed line. So we have this swing high to this swing low. Okay, that's now our trading range. Here, when price pulls back here, we go down to that 15-minute and we look for that liquidity. If we don't have any, okay, we don't in fact have any here. So what we need to do, go down to a 5-minute. Let's go back to that area. Let's zoom in. You'll find liquidity is on every single time frame. So here we have this swing high. Let's mark it out. We create some equal highs here and here. The market doesn't actually break structures downside, but we do then sweep through here, and then we break down and we continue down. Now when we come back up, again, the market is sweeping through this high here created. So we're going to see those sweeps when the market comes back up. But understanding that this was our trading range here to downside, we've pulled back above this. Now, instead of we seeing the engineered liquidity at the reversal, we're finding the liquidity on the way back up here using the line chart. You can see how simple this is. Now, look, if we go back to the 4-hour, let me in fact just wipe all this off, and I'll show you that this will work on a fractal nature, understanding timeframes. So let's look for a swing move here. So we've just broken out this swing high. Let's make a dashed line. So that means we have a trading range right now from this low to this high. We're now pulling back. We go to a 4-hour time frame to current price. When we're at current price, and they can't see those lines at the moment, they've to the weekly, so let's mark this off again. These are our trading range lines. We look for the market to pull back. Now at the moment, we haven't engineered any type of liquidity on a pullback, so we can look left here. We have a swing low here, but the market's now pushed through, okay, potential sweep of this low. But if we look here, okay, we have these lows. One broke structure. You're looking for those areas where you see the continuation. So broke structure as a swing low. Here we broke structure, so that's a valid swing low. That's what you're looking for, that swing pullback. This isn't a swing pullback. This will be one candle. This is a swing pullback. So again, there's a low. Now this is a swing pullback. So I'd actually be looking at marking out this low. And you could also mark out this low. So if you're looking to the left, that's how you identify liquidity, sitting below these lows on these swing pullbacks. Now, when we're looking for liquidity out of here, what we'll be looking for is the market to engineer something. So we can see it's the last push down here. In fact, let me go closer into that move. Now, if we can break through this high here, then pull back, right? So we broke this high. Now it looks like we could potentially go higher. Very often you'll see a small pullback, then drop through to take that low, and then we see the rail move away. That's how they're engineering that liquidity when they pull back into that zone. And you're going to find this will be your sweep area, removing that area of liquidity, and we see the reversal pull back into your area of demand, and we continue higher. That's how we look at the use of liquidity when we're using the combination of that line chart. Now, if you want to follow along with my analysis, then check out the absolutely free Telegram channel right now. You'll find the link below in the description of this video, and there'll be one popping up as well.